Crypto Hotep here with another investing video. We are on week 39 of the family portfolio and dividends tracker. If you're unfamiliar with these videos, feel free and go to my channel and go to week number 1 where I go through the methodology, my thought process, and why I started doing these trackers. So in a nutshell, I shortlisted some stocks for my family to choose from. I gathered up all their choices of stocks and companies, and then used M1 Finance as our broker of choice. Within M1 Finance, you can actually create one big portfolio and have sub-portfolios in it. I created the sub-portfolios with each of my family member stocks, and then every week, we go through these stocks in the portfolio. We discuss what's working, what's not, things that are going on in the market, how we're feeling, how we're thinking, and just documenting that whole investment journey. First and foremost, these videos are for my own edification, but if you find them helpful, feel free to like, subscribe, comment, but they're first and foremost for my family, and hopefully they can see them whenever I'm gone, and hopefully they will be helpful for them as well. But by no means is this financial advice. Please do your due diligence when you're researching stocks. With that being said, we can jump right in, but before we go to week 39, as we all know, we go to week 38 last week. So last week, our balance was $1536.19. We had dividends earned of $10.72. Our money weighted rate of return year to date was an astonishing 33.8%, and that equated to a market gain of 208.32. So this week, we are looking at a account balance of $1593.14, a money weighted rate of return year to date of 39.884 or 39.88%. That equate to a market gain of 249.86. Dividends, we had a little bit more dividends. Dividends earned $11.86. Just fantastic numbers here. Again, if this is your first time watching the video, we started these videos, I want to say around February or so, when our account balance was around $213. So needless to say, this has been a fantastic year. The markets themselves have been great, but something that you need to learn if you're investing is you have to roll with the punches, whether the markets are up or down, because price never goes all the way up in a straight line. There will be pullbacks, there will be corrections, and there will be dips in the market. But as of this year, not so much. So let's see what we have here on our activity. So as we saw before, between this week and last week, we had a lot of dividend activity. So we had Starbucks, 34 cents, the Smucker Company, 4 cents. We had our dividend from Pfizer at 33 cents. Kroger at 4 cents, Aflac at 9 cents, Church & Dwight Company at 3 cents, Visa at 3 cents, and then TJ Maxx at 2 cents. We also had our regular deposit, which was only $15. Yes, these deposits are only $15 every 2 weeks. Your eyes aren't deceiving you, but we have been able to grow that money substantially over time in less than a year. So that shows you the power of compounding when you are investing. So what did we buy with that 15? Well, we separated them. So we had Starbucks, McDonald's, Costco, and then Pepsi. So we wound up buying all 4 of these companies here. And we will go right into the portfolio here. Okay. And as always, guys, we go bottom to top. Wife stocks are at the bottom this week, as with the past several weeks, and we will know why in a second here. So market gain, negative $14.46. Money weighted return was a negative at negative $21.96. And then dividends earned as 56 cents year to date. So again, Celsius has been the Achilles heel, down over 65%. We're still holding that right now. the big thing with the portfolio is with these sub portfolios is I don't want a lot of position movements. We want to select companies that we like, that we feel as though have a competitive advantage or a moat, if you will, and ones that we have confidence in. So we don't want to continuously be day trading or even swing trading these stocks, because this isn't the portfolio to do so. In fact, M1 Finance isn't that type of portfolio as it is. It's more of like a long-term holding technology, broker technology with M1 Finance. So Celsius, by the end of the year, we'll know where we stand with Celsius and how they end the year as a company and what their prediction is for next year. Pepsi is down over 7%. A little bit of surprise about that. Google up over 18, and then Tesla is actually backing the whole portfolio up over 50% year to date. Let's see what we have here. And let's go to our middle stocks. Now, our middle stock, as you know, our middle stock is more of the consistent stock portfolio, our middle. So money weighted rate of return year to date was 29.483%, market gain of 1964, and dividends earned of 49 cents. Just a great collection of stocks, 6 stocks in this portfolio. Amazon, really nobody's stopping Amazon right now with AI, with obviously Amazon Prime, with some of the television deals that they've acquired. Nothing is really stopping Amazon, up over 33% year to date. You can't beat that. Target down over 10% here. Again, that equates to their earnings that were very lackluster heading into the holiday season. I think that they will end the holiday season fine, but markets didn't like that. So again, down over 10% year to date. Costco, if there are 3 things in life that are certain, is death, taxes, and Costco. Costco is consistently strong. Their price chart is one of the best price charts I've ever seen, because it's up and to the right forever. Nothing is really stopping Costco. So Costco is a definite bet here, up over 37% year to date. Starbucks up over 7%. Nintendo up over 15% here. I'm going to click into Nintendo and see if there are any news articles with this. Maybe just another potentially another video game here, another video game for Nintendo, but very good. It's a rarity that we see for our middle Nintendo 15% year to date gain, and then Tesla following in suit, like with my wife's stocks, up over 50% on Tesla. Tesla is having an end of the year, and it is just going crazy. And next we go to our youngest stock. Our youngest is where we start getting into the crazy rate of returns, up over 63% year to date. That's not a typo. That equates to a market gain of $42.24. Dividends earned only 36 cents. But hey, when you have returns like this, over 63%, you forego a little bit of dividends here. So Nintendo up over 26%. We just touched on that. Tesla up over 146%. Ridiculous. That is ridiculous. If you're asking, hey, Crypto Hotep, why is the youngest 146 and everybody else is 50%? Well, I would advise you to go to the first video in the channel, because that's where we showed everybody's stocks from the beginning of this tracker. And one stock that our youngest had from the beginning was Tesla. Bought through the dips, through the FUD, everything, and just held it. Starbucks up over 28% on Starbucks. And then Apple made new all-time highs this week, up over 41%. And what's funny is Apple made new all-time highs very quietly. Everything was centered this week around like Tesla, around Bitcoin hitting 100K. Go Bitcoin. But no big news around Apple hitting a new all-time high. It's funny. It was a quiet, the quietest all-time high I've ever experienced with Apple. Next, we go to our oldest money weighted rate of return year to date, over 90%. Market gain of over $109.22. Dividends earned of $1.78. How do you like that? And there's only 4 stocks. Sometimes you don't need that so much diversification. Sometimes you just need to stick to some main players, and these are the main players. Tesla, again, you've probably heard a consistent pattern here with my family. Up over 77% on Tesla. Apple, again, all-time highs, new all-time highs, up over 41% on Apple. Costco, nothing's beating Costco ever, up over 25% on Costco. And then McDonald's, again, McDonald's was one of the main stocks when we began this channel that our oldest chose. And we were buying McDonald's during the FUD, during the quote-unquote E. coli outbreak that happened. We steadied buying McDonald's. Just overall, fantastic portfolio. And it's good to see the growth, because our oldest portfolio was also at the bottom this year. But steadily, slowly and surely, it just made its way back top. It just shows that when you invest in the quality companies, over time, your money will be in a better place. And then last but not least, let's go to mine. Mine, money weighted rate of return over 21%, market gain of $214.11, and then dividends earned $8.67. Mostly all of my categories are in the green except for pharmaceuticals. Pharmaceuticals have been taking a hit as of late. This is no exception. Pfizer and Johnson & Johnson, of course. We have new administration coming in that are very, I wouldn't say against the medical industry, but very kind of challenging to that medical industry, and the markets don't like that. So that'll become. I'm still holding Pfizer and Johnson & Johnson. They're very great companies. They've been around nearly 100 years, so I'm not really worried about that. Look at the growth in the meme stocks, up over 110%. I wish I had more in them. Of course, everybody says that when they're doing good. But as always, these allocations are only 5% of my portfolio. And, here we have the basic players, if you will: Palantir, MicroStrategy, Tesla, CrowdStrike, and DTE. All in the double digits except DTE. But that's all good. Not really worried about that. And other than that, I think mostly all of these categories are double digits in the green. We clicked on finance. Finance is right now running amok here with American Express, Aflac, Moody's, and Visa. Just a very strong collection of stocks here that I love holding. And that's about it in terms of the family portfolio. So almost cracking 1,600 very quickly here before the end of the year. It's a fantastic feat. Up over 39%, almost 40%. Dividends earned over $11 at $11.86. Market gain collectively $249.86. One thing that I do want to go over, and we can touch base on this, is analysis on one of the companies that I hold, the Hershey company. So the Hershey company has been hit a little bit with a couple of headwinds with their company and with their stock. So I figured I'd look into their financials. So Hershey, as you guys are aware, it's a chocolate company. They make many other items other than candy, but that's what they're basically known for. Several analyst forecasts have them at a sell. Okay. And just at a quick glance, revenue has been peaking up year over year since 2019 here. And if we go to the financials, we'll just look here. So again, revenue. This is one of the things that I like to look at with a company. Is the revenue at least going up? That's my first thing. And with Hershey, it is going up. Revenue growth is somewhat of a mixed bag here. It isn't negative, but again, it's not trekking upwards. It's kind of like up and down, very sporadic here. Operating income is also going up, which I like to see. Operating income, I like to see that go up as well. I like to go to the balance sheet. Cash and cash equivalents. I typically like to see an increase in this and have this go up. If we look at 2019 to 2020, 2020 hit Hershey very hard with the pandemic, and they've just been trying to catch up to those cash and cash equivalents after that big drop off in 2020. Okay. Other items, I look at total current assets. So total current assets, I like to see either increasing or somewhat staying the same. I don't like to see those decreasing. So that falls in line. These total assets, that's also increasing here. Total liabilities, I normally like to see this either at decreasing or somewhat stagnant. Retained earnings, I like to see retained earnings increasing. So it's basically the money that's left over after the dividend that you can pour back into the company. So I do like to see this increasing. That makes me feel good about Hershey. And then their total debt. So total debt, again, either stagnant or trending downwards. Cash flow, I think with Hershey, maybe a little bit of a mixed bag here. Net income, I like to see increasing. That's basically everything after the bills have been paid. So I like to see this shows strong growth here. I'm not mad at that at all. Operating cash flow, I do like to see operating cash flow somewhat trending upwards. This, I'm okay with this. It's somewhat in the same position that it was before. And what else? Free cash flow, I do also like to check out free cash flow as well. And that somewhat has stayed the same here. There's really no red flags right now with Hershey for me currently. Okay, so if we look at their dividend information, they have a 3.14 dividend yield, which is okay. Their dividend growth is an astonishing 22%. That's very enticing. Okay, a lot of times dividend investors will look at the yield, and that'll have them pick or choose the stocks based on the dividend yield. The dividend yield doesn't always tell the story. In fact, it might tell the story inversely, meaning that if the dividend yield is higher, you may want to stay away from that stock if it's higher than most. 3.14 is an okay yield. The 22, close to 23% dividend growth is very enticing. They've had 14 growth years, which is great, and their payout ratio is below my level of concern, which would be around like 69% or so. Okay, so I'm okay with that. They've had decent enough dividend payout here, and nothing really stands out as of yet for Hershey that makes me want to pull them from my portfolio. But it's good to always check them out, see what's going on, and what everyone's in the market saying. And just because the analysts say to sell, analysts get things wrong all the time. So just because you may see something like this does not always mean that they're correct. And that's why you should always do your due diligence in understanding what you invested in and trying to learn more about the financial markets. But as always, guys, thank you as always. I hope these videos were helpful. Feel free to like, subscribe, and comment below if they were. But thank you and happy investing.